All right, guys, we'll get started. Today's going to be a little bit different. You know how I mentioned, for those of you who were here last week, we're trying to implement a new meeting format, different from how we've had it before in previous years, where we've had a market outlook, chief economist and an M&A director, and they were presenting on the market, the economy, and M&A deals. And we're thinking of implementing a new format that we hope will add value to you guys, more value to you guys than our previous presentations have. One of the goals here is, like I said, is to add value, but for you guys to come in and not only just be here, but you're also listening and learning. I know there's many times where I've looked back and I see people on their laptops watching movies and whatnot, maybe having backstage conversations, which we don't care. We don't expect you to listen, but we hope that you guys do come and listen and learn and take something away from our meetings. And that's why we're trying to implement this new meeting format in the hopes that we try to add more value to you guys, and it's not just you guys showing face, but you're actually coming here and learning something. And it might be a little bit more lecture style. We're going to have a preference at the end where it's a QR code, and you get to pick which style you like better, this style or our previous styles. And we want to get your feedback to see what you guys prefer. But we think that we're hopeful that this new format will add better value for you guys, for the society as a whole. So we'll get started. Let's do sign in. All right, so like I said, our meeting agenda, slightly different. No more market outlook, no more economic perspective and M&A director today. It's just going to be me introducing the topic and going with the topic. And it will likely, the way we see it in the future, it'll be like one person or two people talking about a certain topic. Today, we're talking about intro to investments and securities. And we're still going to have the sweet spot at the end as well. So we're going to start off like we always do, outperforming moments. Anyone got any outperforming moments for this week? So,
we had a good time with the outperforming.
Okay. It's not really enough for that's great. Anyone else?
I was trying to explain what outperforming moments are.
Yeah, so I mean, if you guys don't know, maybe you guys are new here, outperforming moments. Why we do it is because we want you guys to say you got an interview someplace, or you got an internship someplace, or something that just you outperformed and you did well on an exam or something. We want others to know about that, about your accomplishments, and we want maybe others to hear your accomplishments and go up to you and start to connect with you and ask you about something. So let's say I got an interview for. I did get an interview for a fixed income position with AllianceBernstein. If others know that and interested in fixed income or specifically AllianceBernstein, they can come up and ask me, something about the interview process, how it was. That's kind of the reason why we do that. Not only to celebrate your accomplishments, but to have others know about it, and it benefits us all. Anyone else?
Participating in my first ever hackathon, datathon.
Nice. What is that?
The datathon, the UTSA datathon this weekend. Do it every year, the second year. So you'll learn a lot about like data analytics. It starts at 9 a.m. on Saturday, ends at 9 a.m. on Sunday. You hopefully make a project throughout the 24 hours. By the end of it, hopefully you can put on LinkedIn and say you went to this program, you learned these things, made this project all in 24 hours. You got to meet a bunch of people that are interested in data analytics.
Nice. That's it. Cool. We'll get started. So this is, like I said, we're doing this meeting format, and there's just some of the topics that came to my mind that maybe you would see in the future if we go with this format next semester or the following years. maybe an introduction series where we're just kind of introducing different asset classes, the financial markets, global markets, right? What value investing is, or more technical things like three-statement modeling, three-statement analysis, options, basics of finance and time value of money, restructuring, distressed debt, specific to industries, careers, introductions. Like these are the kind of topics that I thought that would benefit you guys and would have benefited me if I was sitting in your guys' position as a freshman, sophomore, junior. So I think that with these topics is the direction we kind of want to go with the new meeting format. But today, like I said, we're talking about intro to investments and securities. And while I'm going through this, right, I'm going to have several questions on here. So hopefully you guys are paying attention. You guys can answer those questions. But also, if you guys have questions throughout, and I maybe skip over a certain thing and you get lost, feel free to ask a question too. I'll stop the presentation and answer your question. Okay, so firstly, what's an investment and what's a security, right? An investment is just a way of investing in a certain asset to generate income or get capital appreciation, right? Simple. Maybe many of you guys know that. An investment could be a stock or a bond, right? A security is more of like a fungible, negotiable financial instrument. So like a stock is a security. It's tradable, right? Something else is a security is like bonds. Bonds are securities as well. Real estate is not. Real estate is not a security. Something else is like security is like ETF or index funds or mutual funds. Those are securities and those are tradable. And I added this, and investing is not gambling, right? We're trying to teach you guys how to invest like the institutional investors invest, like the Blackstones of the world invest, not how Wall Street bets invest. So we're not gambling, we're trying to invest, make calculated investments. All right, so factors that will invest in your investment decisions when you're when you're just investing on your own, right? If you have money to invest in the stock market, or when you're already working, these are kind of the factors that you're looking at, or firms are looking at to invest in, right? So liquidity, how fast will you be able to get your money out? If you're investing in stocks, you can get your money out relatively quickly, as long as the bid-ask spread within that is not far. It's not too wide, right? Within real estate, it takes a while to sell something. So if I want to sell real estate, I have to go to an agent. They have to put it on the market. I have to go through all the paperwork once it gets sold, right? Maybe you're going to be on the market for 5-6 months, a couple of weeks, something. It takes a while, right? So it's less liquid than stocks are. Risk, right? There's credit risk. There's currency risk. Credit risk is the credit rating of that specific firm. So if you're investing in a firm that it has a lot of debt, they're going to have a very low credit rating, and they're not going to be that strong of an investment. So it's going to be more risky, right? Currency risk, right? When you're investing across borders, you have to look at the exchange rates. Interest rate risk, right? It kind of pertains to pretty much everything, but specifically to bonds. When you're investing in bonds and interest rates are rising, you're going to see that capital depreciation in your investment because when interest rates are rising, the value of the bond price is decreasing, right? So you're going to see the capital depreciation. And there's inflation rates, right? So if you're getting a return on a bond of say 2%, but inflation is currently at 5%, your real return is only 3%. So you're losing. Is negative 3%, not 3%. So you're losing out on 3%, right? Also, capital appreciation. How well will the investment perform? Is the investment going to appreciate a lot throughout its lifetime? Right? Is the stock going to appreciate? Bonds, you buy it at face value. You'll get it at face value at maturity. There's really no appreciation there. Taxation. Now, how much will you be taxed? If you're investing in stocks, right? So let's say you're trying to trade stocks within a short period of time, less than a year. That tax rate is going. It's a capital gains tax rate. Is going to be different than a long-term capital gains tax rate. So you'll be taxed at a much higher tax rate than you would have if you held it for a year or longer. So that can affect your profit. So that's something that investors look at. And also investment horizon. How long will you be holding the investment? That really matters, because if you're investing, say you invested $100 today and you sold it in a year, you have and you sold it in a year for, let's say, 200, right? So you get your appreciation back. You get your principal back plus the appreciation of $100. Your total return is 100%. But now, let's say you waited, a few years and get the same amount of money back. That total return is going to be lower because of the time value of money, right? So these are some different asset classes that you can invest in, right? So cash is considered an asset. It's very liquid. It's the most liquid of assets, but it doesn't return as much. It doesn't give you as much of a return as other assets, right? That's just cash. You can have your cash in a savings accounts or deposit accounts. Then there's fixed income, right? It's purchasing a bond from the U.S. government or from a corporation, and lending them money in exchange for an interest rate. For interest rate that you're getting money, either monthly or yearly or quarterly, depends on the periodic payments of the fixed income. And there's real estate. Like, you can own real estate two different ways: by buying the actual real estate, which maybe many of us do not have the money for that. I definitely don't have money to buy real estate right now. Or you can buy REITs, right? They're real estate investment trusts that are in the stock market. And those are companies that buy real estate. So you can invest in real estate that way as well. Equities, right? They're stocks, right? They're ETFs, mutual funds, index funds, right? You're owning a share of the business. And commodities is you're just owning a good that has an end use, right? So oil companies have oil, right? They own oil that has an end use. Wheat, if you're trading wheat or investing wheat, right? Those have end uses. So, today we're just going to talk about cash, fixed income, and equities, and a little bit of alternatives. So we're not going to go into everything. So we're talking about cash, right? So cash is the risk for it is slim, right? It's liquid, right? It's liquid. There's really no downside to holding cash, except that you could have been invested in something and made a return, and also you have inflation risk where if inflation is 5% and you're losing that 5% yearly on your money. And characteristics, right? So it's if you're holding cash, just straight cash, there's going to be no return. If you're holding cash in the savings accounts, like your savings account might have 4.5%. That's what mine has right now. I'm using Discover, by the way. I get 4.5% a year for holding my cash in the savings account. So for me, that's not terrible. I need the cash. I need to be relatively liquid, especially in college where I have to pay certain things. So I can't really have my money invested at this time. So for me, it's fine. I'm trying to minimize my risk. Or there's two different ways that you're trying to do. Minimize your risk, which I'm trying to do, or you're just plainly trying to avoid risk. Right? You're trying not to have risk at all, right? So, and if you look at this chart on the right, so this kind of shows if you invested $500,000 in 1988 and you were fully invested during that period of time till now, you would have $10 million from that. Right now, if you sold and held cash for the best 10 days, that halves, right? Now you only have $5 million. So this kind of shows how holding cash reduces your potential for returns, and why it might not be the best call just to hold cash and to stay invested in the market through the turbulence and the volatility that we see in the market. If you do hold cash, right? If investors do hold cash, they're shopping for bargains, right? They're trying to find deals. Like Warren Buffett holds several $100 billion in cash, and he's just waiting for a perfect time to buy a stock that has good profits, but it's cheap, right, relative to their value. So that's what he's doing. He's shopping for bargains, right? Just opportunities. Right? Or you have a lot of volatility, and you're trying to reduce the risk within your portfolio, or the volatility within your portfolio, and you're holding cash, right? So it's a little bit more stable. It's obviously not going to go down or up. And you're hedging risk, right? If the market's going down and you want to capitalize on buying short options or put options when the market's going down. So a way you can do, like I said, I'm investing in high yield savings accounts, right? There's several high yield savings accounts out there that right now are paying like upwards of 4%. I think some are at 5% right now. So like it's a way to easily kind of make a return without having to invest in the market and have that risk, right? With the interest rates being high right now, you get that ability to have a 4.5% interest rate. With this, like compounding is very important. So compounding, and if you guys don't know, it's when you earn interest on your interest, right? So let's say here we have an example. You invest $100, you have 4% interest rate, and it's compounded yearly. So after the first year, you're going to have that $104. 100 times 1 plus the 4%, 104. Second year, you're going to have that $104, and you're going to earn 4% on that 104, not the $100. So you do 104 times 1 plus 4%. Now you have 108.16 cents. So obviously, when you have a lot of money, that really makes a difference, and it's not just 16 cents. The drawback of this is inflation, right? So if you have cash and you're holding cash, if you say you're at $50,000 in year 0, you're gonna have $50,000. In year 10, you'll lose 26% of your purchasing power with 3% inflation. In year 20, you'll lose 45% of your purchasing power and down to 27%. So it really shows that why investors invest, because the purchasing power of your money today will be worth less in a year, 5 years, 10 years from now. So why invest is another little chart. Just if you look at the red line, Joey, right? Joey invested $200 a month, like everyone else, but he started at the age of 45. Right? He contributed only $48,000. Now Jill, she started early, 10 years earlier, investing the same amount. Now she's at $72,000. So she got a little bit more money by investing 10 years earlier. Jack invested 20 years earlier from Joey, same amount, and he has $96,000. Right? So this is just a simple illustration of why you maybe hear a lot why investing earlier is better, right? Because your money is going to be compounding and compounding throughout those years. All right, so we have a first question. I guess I'll ask first. Anyone have a question on what you have? Everyone good? Pretty easy. All right, so question 1: would you rather have 100 now or $100 later?
Yeah.
Now? And do everyone agree?
No.
No? Who said no? Why not? Or would you rather have $100 later? Well, that's why you would want to invest, right? So if you invest at 100, if you get $100 now, and then you invest it, you would have more later. That's fair. That's fair. But the thing is, like, would you rather get? So if I say I would give you $100 right now, or in 10 years I'm going to give you $100, which one do you want? Yeah. So it's $100. Right? You want $100 now, right? Because the simple thing that everyone knows, and for this answer is, money today is worth more than money tomorrow. Right. So in other words, you want that $100 today because that's going to be worth more than $100 in 5 years from now. And so I have it here written. You guys can read it if you want. I'm going to explain it. The main reason, right? There's kind of two reasons, but a lot of people think it's because of inflation. Right? Inflation is going to erode your money, and that's what it's said right now. Right? Because inflation will erode your money if you don't invest the $100. But it's also because you want $100 today because you could have invested that money like in a 5% interest rate 5 years from now and had more than $100 5 years from now. So that's like kind of the real reason. It's the opportunity cost of not investing. Right. All right. Now we're going to go to bonds. All right, anyone? What are bonds? Yes. What are bonds?
it's a form of basically buying that is the corporate and full government. And so you're essentially buying that only for, of course, you're borrowing it for, and making return on it.
Anyone else? Yeah, it's right. It's debt, right? It's bonds are a form of debt, right? What they are is like, I'll issue. Say I'm the company and you guys are the investors. I'm going to issue $100 bond, right? I'll get you guys will give me $100. I will pay you guys say 5% for lending me $100, and I'm going to owe you guys in 5 years, right? So I'll owe you the $100, and I'll be paying you the 5% for 5 years, right? Every year. That's a bond, right? And why do companies issue those bonds? Really the main reason is to raise capital. And bonds are usually, or debt is usually cheaper than raising equity. So they raise debt to not dilute their ownership and to raise capital to fund their operations or investments that they're making, right? Why invest in bonds, right? So why would you guys invest in bonds? Why would firms invest in bonds, right? You get a steady income, right? Right now, U.S. Treasury bonds right now, the 10 years at 4.8 now. It might have gone lower. 4.9. Right now, okay, 4.95 today, right? So almost 5% on a 10-year. Which is really hasn't been unheard of probably since we've been alive, since we've been able to understand what the bond market was. So it's pretty high right now, and what they do is they invest in the U.S. government bonds because they're deemed the safest investment, and that's where most investors go when there's really kind of turbulence going on in the world. Or stocks are going crazy, or there's war, people flock to U.S. government treasuries. And it reduces the volatility within your portfolio. So if I'm investing in equities, and equities are down right now, right? Stocks are down, maybe they're going down, going up. That's what they've been doing, right? But bonds, you'll always be making that 5% throughout the whole period. So it stabilizes your portfolio and it makes you kind of still have reliable returns over that period of time.
Is that what's also called the rate?
Yeah. So U.S. Treasuries are also called a risk-free rate, right? Because they're deemed risk-free, right? The government has never defaulted on their debt. U.S. government has never defaulted on their debt, right? Not yet, at least. So here's the hierarchy. Right, so on the top is the higher risk, right? The higher default rates. They have higher risk of defaults. Their yields will be higher, right? Investors are going to demand a higher return because it's riskier to invest in. At the bottom, you're going to see the lowest risk, right, which is U.S. government bonds. And U.S. government bonds, like I said, are the lowest risk because the government has never defaulted on their debt. Because if they never defaulted on their debt, they're deemed lowest risk. Also because the U.S. government can just keep printing money until they pay back their debt. So that's another reason. Right. So it's called safe haven asset. Right? When the Israeli war happened, when Ukraine, Russia happened, investors started buying these treasuries, which pushed down yields for a moment, right? Because when they're buying treasuries, that's increasing the demand, so that's increasing the price for those treasuries. So bond price and yields work inversely. So if bond prices are going up, the yields are going down. So for a brief time, yields turn around and they started going down for a brief time. Obviously now they're going back. Now they're back up. So then we have I'm just going through 4 of them right now. These are kind of the most common that you'll hear. Mortgage-backed securities are just a collection of mortgages bundled together, right? You have prime mortgages and there's subprime mortgages. Subprime are just less credit quality mortgages, right? They're bundled together. Corporate bonds, these are issued by corporations, right? Just Apple can issue bonds for say 4%, a percent lower than the U.S. government because they're a corporation, obviously, but they might have the same credit quality, but they're more risky because they can't print money like the U.S. government. High yield bonds, right? These are just riskier bonds. They're below investment grade, right? They don't have the credit quality of Apple or an Amazon or the U.S. government, and so they generally require a higher interest rate. So investors want higher returns. Right, so the bond ratings. There's 3 bond rating servicers: Moody's, S&P, Fitch, S&P, which is Standard & Poor's, and Fitch. Right, they rate them differently, but they're all like really almost the same. Right, so we're gonna go over what Standard & Poor's is right now. That's kind of the most common. Right, so the very top, highest credit quality is AAA. Right, AAA, is like the U.S. government. Right, it's the highest credit quality. They have the least default risk, and they're rated AAA by Moody's and S&P. This year, in August, Fitch downgraded them to AA+. Right, so Fitch is the only bond rating servicer to have downgraded the U.S. government. S&P and Moody's are still at AAA. And then you start high yield, right? I mentioned high yield bonds, and high yield bonds start at when it's non-investment grade, so below BBB-. Below that, you have non-investment grade. You have non-investment grade, which is high yield bonds. But you have speculative, then highly speculative, and then extremely speculative and default. Why would someone invest in an extremely speculative default company, like in their bonds? High returns, but you have the risk of default. You might not get your money back.
The risk of you're young, thinking on more risk.
Yeah.
They think the economy is not going to go bad. The company's going to stay alive because the economy doesn't go down. If the economy goes down, I'm pretty sure the company's going to go under. But they're like, well, I don't think it's going to.
Yeah, that's those are good reasons. If investors want the high risk, right? We have the ability to lose all your money, but really make a lot of money. Maybe you're making 14% yield on that, right? But another reason is like if the firm thinks that it's a good investment and it will stay or will get better in the future, right? They have the opportunity to invest when it's at a very low price and influence the restructuring process before that company. So that's why might some private equity firms who might invest in like a distressed debt firm, right? That's distressed, maybe it's going through restructuring, and they're going to invest in that kind of credit quality. Any questions on that? Okay. So now cost of debt. There's two, or actually about the pricing debt. When we're pricing debt, what's important? Right, there's two really important interest rates, right? Obviously the coupon rate. Coupon rate is just the whatever is contracted on the bond. So if the bond is issued at a 5% interest rate, you'll be making that 5% throughout the whole maturity period or investment hold period, right? And there's a market rate. So the price can fluctuate after it's issued. If investors think that the bond or the company is actually riskier than they think they are, and they think that they should actually get a 6% return, then the price is going to fall and the yield will drop, right? So, the yield will rise. I'm saying the price falls, yield will rise, and so that's usually the yield to maturity, right? You have the yield to maturity, which will rise because investors won't think that the company is more risky, and so they want a higher return. Then there's cash flow, right? The periodic payments that periodic principal payments that you guys will be getting, or companies will be getting, to invest in bonds, and then also the principal payment at the end. So let's say I just mentioned if the yield to maturity is lower, if the yield to maturity is high, then the coupon rate, the price of the bond is lower. Let's say that it was issued at 100, now it's 95. You buy it at 95. And when you hold it to maturity, you're going to get back the $100 of face value, right? So you get the $5 appreciation plus the interest rate you're making throughout, and that's why you get that higher yield. So cost of debt is kind of from the company's perspective, right? What will it cost them to issue bonds, right? That matters when they're trying to issue bonds or get loans from finance companies or from banks and whatnot, right? So when they're trying to find the cost of debt, they're going to be looking at what the cost of equity is too. What's the cost of issuing more equity, more shares in the market? All right, so now we're going to go over equities. I'm going to mention that right now, actually, and why someone would invest in bonds over equities. Just wait a few minutes. Alrighty. We have equities, right? There's different types that you can invest in the stock market. There's like growth stocks, value stocks, income stocks, blue chip stocks, penny stocks, right? These are kind of some examples. Obviously, Amazon's not a penny stock. I'll explain why I have it there. But so growth stocks, it's like a Tesla, right? So they're in a high growth market or a very new industry where investors are expecting there to be, high demand, high growth rate in the future. Tesla, AI is one of them. Electric vehicles is one of them. Technology especially too. Like these are high growth industries. Right? Value stocks might be a Target. Right? Target, I put it there because it is it's a well-established firm that is still making money, and their cash flows are still great. They're still profiting, but they've had a recent sell-off in their stock. So I haven't done the calculations, but their intrinsic value might be lower or might be higher than their price, right? So it might be a good investment to make if you're looking for a value investment. So that's like why some investors invest in value stocks. Famously is Warren Buffett, who invests in value stocks. He also invests in income stocks, right? So like a Coca-Cola, they're well established. They don't really appreciate much, right? They're just kind of going with the market, maybe even making less returns with the market, but they're giving you dividends, right? So the dividends make up that return. And so famously, I think it was like a while back, Warren Buffett made more in dividends than the CEO made on his salary, right? So like that's the power of dividends, right? From Coca-Cola. So he made more in dividends from Coca-Cola than the CEO made from their salary and bonus. So that's why some investors invest in dividend paying stocks or income stocks. And there's blue chip stocks like an Apple. These are just like well-established firms, right? They have good records of growth in their stock price, in their profits. And then, kind of like Amazon right now too is a blue chip stock. Now I have Amazon as a penny stock because they once were a penny stock. And so a penny stock, what that is any stock that was trading at below $5 in the market, right? So they're below $5 at one point. They were considered a penny stock. I think Amazon was trading, they IPO'd like around $2 or something like that, I think. And so right, they were very inexpensive, but no one knew what Amazon was going to be. So they were also like very risky and speculative, right? Like no one knew, like they were the first companies to be like on the internet. So no one really knew how well Amazon was going to do. And another example of this is like biopharma companies when they're researching to issue out a new medicine, right? So maybe they're trying to cure diabetes or something like that. They're gonna do all this research and they have to go through FDA trials. When they're passed, they're gonna be not valued at all because they're gonna have no cash flows at all. Right? So people are speculating that their drug will get passed by the FDA. So if it does get passed by the FDA, and they're gonna have their stock price is going to skyrocket, and the investors are going to make a lot of return. Right? So that's an example of a penny stock. There's many more examples of penny stocks. So companies' capital structure, right? You have the assets like cash, PP&E, investments in tangibles, and these are all financed by debt or equity. Right? The debt is just a fixed claim on assets. Now I'll explain that shortly. It's money owed to creditors, right? It's what you owe to your bondholders or the people you've gotten loans from, right? So if you got a loan from Wells Fargo, you have to pay them back. That's debt, obviously. Equity has a residual claim on the assets. I'll explain what that means right now a little bit more. And these are just owned by shareholders, right? So if you're investing in Apple through the stock market, you're going to be an equity investor. So a little bit more on the company capital structure. When you're investing in companies through debt or through equity like stocks, right? There's a capital structure that goes in the event of defaults, right? So the common stock at the very top has higher risk, and it usually has higher return because investors know that it's high risk and they're going to want higher return. And then senior debt has lower risk and lower return. And why senior debt has lower risk is because when in the event of default, they will get their money back first. So what happened to SVB or Credit Suisse, right? That they defaulted. Who got paid out first was those debt holders, right? When they sold their assets, or when who bought them? Who bought them? Who bought Credit Suisse? Who?
UBS.
Yeah, UBS. That's right. UBS bought Credit Suisse, and they bought them for like a very cheap price, right? Obviously, it's not going to fulfill all the debt holders and all the equity holders what they were before, right? So, I think only debt holders got paid out, and the equity holders were left with nothing. So that is why senior debt, when you issue debt, it's usually at a lower cost, at a lower interest rate than what common stock is going to want, right? They're going to want a higher return because they get paid out last in the event of defaults. Everyone kind of understand that concept? Yeah. Okay, cool. Equity, right? So equity is stocks that are issued in exchange for cash, right? That's the same thing. It's bonds or loans that you receive in exchange for cash. And then those profits are just reinvested back into the business and then sold off to bondholders or equity holders, and equity holders in the form of dividends, right? All right. So question 2 here: what has a cheaper cost of capital, equity or debt? If a firm is in between, like issuing equity, right? So maybe they want to issue more shares, or they want to issue more debt, and they're trying to figure out, what is going to have the lowest cost. Which one would the firm choose? What is that?
Because they get their money back first.
There we go. Everyone agree? Debt? You guys agree? All right. Oops. Yeah, so it's debt because the cost of equity, like I stated before, it exceeds the cost of debt. The risk to shareholders is greater than the risk to bondholders or debt holders because they get paid out last. Right? Equity investors aren't guaranteed capital gains. They're not guaranteed their investments back. They're not guaranteed the dividends they make. But bondholders are guaranteed their money back. Right? It's really like bondholders are guaranteed their money back, like really by law. So that's kind of what differentiates, or why the cost of debt is different from the cost of equity, and why equity is higher. All right, question 3. Why would a company consider issuing debt instead of equity? Kind of already talked about this. Yeah. What else? You just mentioned it. Yeah. Anyone else? Yeah. Basically, it's cheaper for the company, and it's also better for the shareholders, right? You're not diluting the shareholders. You're not making the shareholders, upset because they're losing their percentage of ownership within the company. Right. Also, got to mention, when they're issuing debt, if the debt, obviously debt cost is usually lower. Maybe right now it might be around the same or a little bit higher, right? but debt cost is usually lower. And so when you're calculating WACC, right, WACC is the weighted average cost of capital, and that's used when you're creating discounted cash flow models or LBOs, right? And you want to calculate the value of the firm, you have to use WACC to find the WACC, and you take the cost of debt and the cost of equity to find WACC. And so if you want to lower your weighted average cost of capital and the cost of debt is cheaper than the cost of equity, then you might issue bonds instead of equity. All right, now we're going to alternatives. Right. So these are just like, obviously, us right now, we can't invest in private equity, but we don't have the money for that. There's like a threshold. I think you have to have several millions of dollars. So we'll be there one day, but we're not there yet. Private equity is just investing in a company with the aim to build up their revenue or restructure them in some certain way. And those returns are pretty high, right? You're going to get 15 to 25% return. Venture capital, you're investing in very new companies, maybe with no revenue history at all, or very little revenue history. They're startup companies. And for that reason, there's more risk, and you're going to expect higher returns. My voice cracked there, sorry. Private debt, debt is cheaper. So you're going to obviously get lower returns, but firms invest in private debt because it stabilizes. Like if you're investing in both private equity and private debt, you're going to have a stabilization within your portfolio. Less volatility. Yeah. Let me drink some water real quick. All right. Hedge funds. Those, they're investing in a very short period of time or a long period of time. Usually a kind of short period of time. And those range are usually not high, like 2% to 15%. And then real estate funds, right? You can invest in real estate by owning a piece of real estate, commercial property. You can own an office building, you can own an apartment building or something. You can make pretty average returns there, 5 to 20%. And on all these, the hold period is pretty long. I mean, it's pretty different, I bet. So private equity, those are 5 to 10 years. Venture capital is 5 to 10 years. Private debt is a little bit shorter. Hedge funds is obviously a little bit shorter too, and real estate funds are kind of in the middle. All right, so we're talking about like diversification within your investments in your portfolio, right? So there's kind of different stances you can take when you're trying to diversify your risk, right? You can have a conservative profile with very little risk, and you're investing more in bonds for stable returns and not so much the appreciation of equities and have that associated risk that comes with investing in equities. So you might have a portfolio made up of mostly 80% fixed income or 20% equities, right? Or you can go up to moderate where it's like you're at 60% equities, 40% fixed income, and you want a little bit more, you're okay with a little bit more risk because you want a little bit more returns. Right. So for conservative, you usually see that for maybe people that have already retired and they don't want that risk associated with investing in equities and they just want stable cash flow. In growth, right, you want a little bit higher risk, right? You want more risk, more return, and you're okay with that risk because you're young and you want as much money as you can when you're older. So you'll invest in equities a bit more, but you still want a little bit of stableness within your portfolio. Now you're super aggressive. You can just go 100% equities and 0% fixed income, and you're just ballsy at that point and just want all equities. Question 4. All right, the last question here. It's why you're an employee of United Airlines and receive company stock every year. You have no other investments besides what you receive. You realize that your portfolio is susceptible to risk. If the airline company fails, what investments might you use to balance the risk?
You might find a CDE certificate you already have versus what you have if you have enough to match the stock. But I think that would be all right.
One way.
Real estate, feel like
Yeah, that's another one way too.
buy the stock of competitors.
You could, and you're still in the same industry, though.
I mean, how much should you invest?
Yeah, that's,
Maybe you're
that's,
still- you're still bullish on everyone, but you're just not this.
that's fair, that's fair.
You know, shorter than that.
Yeah, you could short United if you want. You will, that's a way to hedge your risk and you short it while you're going along on it as well. Like you guys mentioned it, some of you guys mentioned it, it's like you want to avoid investing in that airline specifically, but maybe also in the airline industry and diversify your investments into other industries like healthcare, clothing companies or whatever, or invest in real estate or debt or bonds to diversify that risk, right? I have this cute little meme here. It says, how many times have I told you not to put the children in one basket, right? It relates there. You don't want to have all your money in one stock or in one industry altogether. All right, so that's it for today. This is kind of like the idea we have for the new meeting format. And with this new meeting format, there comes a little bit of changes within the officers. Now, I kind of want to go through it with you guys, the different changes within the officers, so you guys know what those changes will be. And when we put out the form to vote, you guys can vote accordingly and have all the information for that. I guess before I move forward, like, anyone have any questions on what I just presented?
You're talking about shorting, and I know that was when I watched The Big Short, it was like they kind of made their money by buying credit default swaps.
Yeah.
And shorting it. How is it? What exactly are you buying?
Yes. So what credit default swaps are kind of slightly different, right? So credit default swaps are insurance on that CDO, right? On that the collateralized debt obligation, and what they are is basically it's insurance, right? So if the CDO, the value of that drops and the risk increases, the value of that insurance packet is going to increase. And so if when you're investing in mortgage-backed securities and you think that the mortgage-backed security market is going to fall, you're going to invest in the credit default swaps, which is basically shorting the mortgage-backed securities market. Right, you're buying insurance on that CDO. But shorting it's a little bit complicated. I don't even know too much into it, but you're selling those shares to other investors to buy back in the future. Maybe if it goes down, you're going to make money, and the other investors are going to obviously lose money. So, any other questions before I move on? Good, cool. All right. So there's a slight change, not totally different. Right, the president's the same. The same duties there. Director of operations is basically the vice president. The few new duties added on. The big change here is the director of investment research. Right, so instead of having the market outlook, the chief economist, and the M&A director, right, how we've had it in the past and how you guys have seen it throughout this whole semester, we're only going to have the director of investment research. And so that person will be in charge of what I just did today, is researching the topic, putting the presentation together, and then presenting that presentation, right? You're going to be in charge of an investment research team, right? So you're going to be in charge of 2 investment research associates, and those aren't elected. Those will be interviewed for those positions, and if the director of investment research will interview people, and they'll pick whoever they think would fit in their team for the investment research team. That's like really the biggest change, right? We're taking out these 3 presenters, and we're just having 1 or 2 up here. So the director of investment research and one of their team members up here presenting you a topic, or if you guys choose that you don't like this, when you guys vote, you're going to have the option to vote for either this kind of format, or our current format, how we have it. Right, so director of finance, just the treasurer, doing the same thing. Now we have director of public relations that we're looking to add in exchange for taking out 2 other ones. through Market Outlook, Chief Economist, and M&A Director. Director of Public Relations will just be in charge of our website and our email, right? We don't, as of now, we kind of lack someone that is in charge of that. And I think adding the Director of Public Relations will help us be more up to date on our website and be more up to date with sending out emails and responding to some of you guys fairly quickly. And so like we're not only selling you guys events through social media and through our group chat, but we're also telling you guys through email as well. It's just so we have different means of communication. I think that this position would benefit from that, or the society would benefit from that. Director of Outreach, they're basically director of events. Same thing as director of events, but now they're going to have an outreach team as well. They're going to have 2 outreach associates that are interviewing for those positions, and they'll be under the director of outreach, right? So, I think we've noticed that we were planning a lot of events and we need help with those events. And so having an outreach team, really helps with those events and gets everything streamlined and makes everything efficient for us so that we're offering you guys the best, events and best quality events too. So you guys are taking something out of it and it's not, last minute things that we're telling you guys and you guys don't know. So that's the idea of adding an outreach team. Director of Marketing is the same thing as we have now. Thinking of adding a Director of Education too. We started this analyst program. The Director of Education will kind of head the curriculum for that program, working with Professor Sweet, trying to get those educational workshops up and going. Maybe add a new program, help be in charge of those resume workshops, everything, those LinkedIn workshops, everything. A Director of Education will be in charge of all that. And then we're thinking of adding an Alumni Advisory Board. I think it's been tried in the past, but I think it would be great to bring it back, right? So like I'm graduating this semester. I still want to give back to I just still want to give back to you guys. And I think other students that are graduated or have graduated still want to give back to the investment society. We haven't done a great job of keeping up to date with our alumni. We're actually working on a database for that. We're working with the Business School Alumni Council. They're going to make us a database just for the investment society. And I think it's a good idea to add this alumni advisory board so that the alumni advisory board will be a way of linking the alumni and the current students and the current members, and kind of helping with the strategy and the direction of the investment society. So this is the overall change, right? So it's just we're taking out those 3 positions and then adding 3 new positions, right? 3 new positions, and then plus those research associates or outreach associates. So now, we're going to do this meeting preference. It's basically just going to ask, what do you guys prefer? Do you guys prefer the Market Outlook to come up here and give a market update? The Chief Economist to come up here and give an economic update, and then the M&A Director to give an update on M&A, what's going on with M&A, or do you prefer these more specific topics where we're diving into like these more technical topics and giving you guys more specific things on a specific topic? And it's not really a market update; it's more a technical thing. So you guys choose there. Your answers will kind of dictate the direction we go. We'll look at it, tonight and tomorrow, and probably, send it in our group chat, whatever we vote on, whatever you guys voted on. And if it does change, this is going to change the direction of our elections, right? So our elections are in 3 weeks, 2 weeks, 3 weeks. Our elections in 3 weeks. We have 2 more meetings and then the elections. Right, so our next 2 meetings, we have an alumni coming. He's working at Jefferies, distressed debt, and then we have not distressed debt, just distressed in special situations. And then we have the CEO of SWBC coming the following week after that. So we want to update you guys about the change as soon as possible, so that you guys know the change and the changes. And if you guys are running for it, you guys can change your positions that you're running for accordingly. All right, cool. We have a sweet spot now. No? It's 8. Oh yeah, shoot. Okay. All right, I'll do updates. Upcoming events. We have the happy hour networking mixer tonight. Some of us are driving there. So if you guys need a ride and you guys don't have a ride, we're open to giving you guys a ride and then dropping you guys back off, maybe at your apartment if it's close by, or here at UTSA after that networking event. We're going to go right after this. We have the Women in Finance panel via Zoom. We're going to, we haven't sent it, did we send it? I don't think I've sent it out yet. But we're going to send out an email with the Zoom link, right? We're going to have 3 panelists there that were UTSA alumni, Investment Society alumni, and they're all extremely successful. There's a vice president at Goldman Sachs, a principal at Blackstone, which is really one of the highest, I guess, ranks that you can get in companies. And then another associate at Goldman Sachs. So these are successful alumni, and it's great to learn from them. Not only if you're a woman, but also a man. Like, you can go and learn something there. We're going to send that out via email, and we're going to put it in our group chat, the link for that too as well. So keep on the lookout for that. That is next Thursday. VIP speaker series. Like I said, the SWBC Investment Services CEO is coming in our general meeting 2 weeks from now. So now this next week, the following week. That's not going to be here in this room. That's going to be in the first floor. So if you go down like the stairs towards the FSC, if you just do a U-turn and go straight back that way, it's going to be like a little conference room. That's where we're going to be. It's a much nicer room than this. So we're hopefully we can secure that for future speaker series. We have the mock interview November 9th, elevator pitch night here. You guys, we're gonna send out a RSVP because we're gonna have this only like an hour and a half to be there. So we're gonna do different time sections, right? So we're maybe only gonna get like 4 or 5 people within that. So it's gonna be like whoever first come first serve basis. You sign up for it, you get a space in the mock interview. And then for this, we're gonna expect you guys to send us your resume and send us a career you want to go into, but then also, when you're coming to this mock interview, you're going to come in, with a suit, professional for men, and business professional for women, and really make it similar to a mock interview. So we want your resume because we want to tailor the questions to your resume and your career that you want to go into. Resume internship night here. Basically, it's November 16th. You're going to come in, and if you need help with updating your resume, we'll help you guys update your resume. And then there, you're also going to be applying to internships. So we'll if you don't know how to search specific internships and find the internships you're looking for, we'll help you that. But then also when you're applying to these internships and you have questions in your application, we'll help you with the questions in your application as well. Towards the last week of school, we had the Professional Business Society Networking Mixer. It's a cocktail style event, and you're going to network with alumni and other students that are in different organizations. I think they're inviting accounting society or marketing society going there. So it's different students within the business school. So it's a great place to network with different firms and different alumni that are working at different firms there as well. We have our fall formal. The location says University Ballroom, but you might switch that depending. So keep up to date on that one. That one, it's our thing. We kind of recognize the graduates, officers that are leaving, and then officers that are coming in. Also scholarship winners for that. All right, like every fall 2023 classes, we've been having Wednesdays at 6 p.m. The analyst program, we had this morning. Next meeting, I'll get you right now. Next meeting for the analyst program is valuations. So if you guys are interested in learning valuations, go to that meeting. We have technical analysis coming up this Thursday, tomorrow, technical analysis.
It's gonna pop up tomorrow. So technically.
Okay, you might. Okay, so it might be canceled tomorrow, technical analysis, but on Monday, there's wealth management at 4 p.m. I know those guys are teaching some good stuff. November 6th, they're actually bringing in some person that's within wealth management. They're working at Wealth Watch Advisors, and they're going to talk about what they actually do in wealth management and all the things that within investments and valuing investments and making investments for their clients. And they're going to bring in two people that are studying for the CFP exam. So if you guys are interested in becoming certified financial planners, definitely go to that meeting on November 6th. Again, just our calendar here, last thing for October, so networking mixer tonight. November, we have, a good amount coming, right? Mostly, we have our meetings, the SWBC Investment Services, and all these events that I just mentioned that are on Thursdays, as well as our fall formal, on the 29th. We don't have anything the week of the 20th, because that's obviously Thanksgiving, so we don't wanna bring you guys in on a Wednesday. I don't think anyone will show up on a Wednesday. Cool, society merch. Unfortunately, the polos still have not come in. We already ordered them and we're waiting for them to come in. It's been like, what, 2 weeks already?
Yeah.
Like, so. Yeah, so hopefully it comes in soon. We'll have those polos for you, hopefully by the end of the semester, and definitely by next semester too. Cool, that's it, guys. Thanks for joining in.